In March 2020, the S&P 500 dropped 34% in 33 days. Not 34% over a year, 33 days. Trillions of dollars in wealth gone. Retirement accounts gutted. And the news was relentless. Pandemic, economic collapse, the worst crash since 2008. Millions of investors panicked. They sold. They locked in losses. They swore off the market. And then something remarkable happened. The market recovered. By August 2020, just 5 months later, it had fully rebounded. By the end of 2021, the S&P 500 was up over 100% from its March low. The investors who did nothing? Who stayed the course? They came out richer than they started. So the question isn't whether the next crash is coming. It is. The question is, how do you prepare your mind for it right now? The Stoics had a concept they called the dichotomy of control. Marcus Aurelius put it this way: you have power over your mind, not outside events. Realize this, and you will find strength. When a market crashes, here's what you cannot control: the Federal Reserve's interest rate decisions, geopolitical events, corporate earnings reports, investor sentiment, algorithmic trading, and every headline that sets the financial media on fire. Here's what you can control: whether you sell or hold, whether you follow a pre-written investment plan or react to fear, whether you add to your positions at a discount or abandon them at the worst possible price. That's it. 2 categories. Everything else is noise. Most investors spend 95% of their mental energy on the first category, the one they cannot change, and almost none on the second, where all the leverage is. Let's be specific, because specifics kill fear better than philosophy alone. The Dow Jones fell 22.6% in a single day on Black Monday, October 1987. Within 2 years, the market had recovered entirely and kept climbing. The 2008 financial crisis saw the S&P 500 lose 57% from peak to trough, the worst financial collapse since the Great Depression. Within 5 years, the index had fully recovered and reached new highs. The COVID crash of 2020, 34% in 33 days, full recovery in 5 months. Every single major crash in modern history has been followed by a full recovery and eventual new highs. Not some of them, all of them. Epictetus wrote, "Seek not that the things which happen should happen as you wish, but wish the things which happen to be as they are, and you will have a tranquil flow of life." A market crash is not a catastrophe. It is a regular feature of capitalism, as predictable as winter following autumn. Here's what actually happens in your brain when markets fall. The amygdala, the brain's threat detection center, cannot distinguish between a tiger charging at you and a portfolio balance dropping 20%. It responds the same way. Flood the bloodstream with cortisol, suppress rational thinking, demand immediate action. That impulse to sell is not a financial decision. It is a biological one. You are responding to a number on a screen the same way your ancestors responded to predators. Behavioral economists have documented a phenomenon called loss aversion. Humans feel the pain of losing $100 approximately twice as intensely as the pleasure of gaining $100. Your brain is structurally wired to overreact to downturns. Knowing this doesn't make you immune to it, but it creates a gap, a pause between stimulus and response. And that gap is where rational decision-making lives. 3 concrete approaches that apply Stoic principles to real portfolio management. First, write your investment plan before the crash, not during it. Write down exactly what you will do. You will hold. You will not check your portfolio more than once per week. If the market drops 20%, you will add to your positions rather than reduce them. This pre-commitment is a Stoic technique called premeditatio malorum, premeditation of adversity. You rehearse the difficulty in advance so it loses its power to surprise you. Second, reframe the vocabulary. A market crash is not a loss. Until you sell, it is a paper decline. More precisely, it is a sale. The same company you bought at $100 per share is now available at $70. If the underlying business is unchanged, you are being offered the same asset at a 30% discount. Third, measure differently. Most investors track portfolio balance, which fluctuates wildly and triggers emotional responses. Track shares owned instead. During a crash, if you keep investing, your share count goes up. When the price recovers, those extra shares multiply your gains. Seneca wrote, "It is not that I am brave. It is that I know what things are truly dangerous and what are not." A market crash is not truly dangerous to a long-term investor who doesn't need the money immediately. The truly dangerous thing is making a permanent decision, selling, in response to a temporary condition. The next crash will come. Your plan for it starts today. If this framework resonates with you, subscribe. Every week, we explore how ancient Stoic principles apply to the concrete decisions of building wealth. Next video, we examine whether the FIRE movement, financial independence, retire early, is actually compatible with Stoic philosophy, or whether it fundamentally misunderstands what freedom means.